In this video, we're going to look at Public Storage. And Public Storage is a REIT that owns and operates self-storage facilities. They have 2,500 facilities across the US and they have over 1 million customers. What I do in my videos is I run my discounted cash flow model to figure out the real value of a company's stock. I also look at the financial ratios of the company and compare them with their competitors. And I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $33.6 billion. So it's a pretty good sized company. And they're trading at $192.30, so that's one share, $192.30. And we're gonna pull the actual free cash flows for the past 4 years. And the way you value a company or an asset is you estimate the future free cash flows, then you discount that number back to today's value, which is exactly what I'm doing in this video. Now I'm pulling the net income, which is the profit and loss according to the income statement. Now I'm pulling the revenue, which are the sales for each year. That's also on the income statement. And you want to take a quick look at the numbers. They look really good. 1.2 billion free cash flow, and then it jumps each year up to 1.4 billion. Net income is kind of steady. And look at their margins, 50 to 60% margins, really strong margins. This looks like a really healthy company. So let's look at a capital structure so we know what discount rate to apply to the future cash flows. They paid 45 million of interest on their debt. And then let's see how much debt they have. We'll go to the balance sheet. We'll go to the liability section. And current debt is debt due within 1 year. No current debt. Long-term debt of 1.9 billion. That's debt due after 1 year. So they pay only 2.4% interest on their debt. Let's get the beta because we wanted to figure out the volatility of the stock so we know the cost of equity. Really low beta, 0.13, so it really doesn't move much of stock. So lower the beta, the less volatile and less risky the stock is, which means it has a lower weighted average cost of capital, and that's a discount rate. Now we're going to look at the balance sheet to get their current assets, because we're going to look at the current ratio later, and in the numerator of current ratio is current assets, and that's 409 million. And in the denominator of current ratio is current liabilities, and that's 383 million. Now we need the equity, which is $9 billion. That's assets minus liabilities. We'll put that in. And next we're going to get the EBIT, earnings before interest and taxes. On the income statement, that's called operating income. And that's 1.5 billion. And we need all these numbers for the ratios we're going to look at later. So let's look at a capital structure of the company. 2.4% cost of debt, and they have 17% debt. 3.3 cost of equity, and they have 83% equity. And the WACC is 3.2%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. And we figured out those estimations based off of the prior 4 years of free cash flows, as well as the prior 4 years net income and revenue. This is the free cash flows right here in white. The forecasted free cash flow we had to discount to today's values, which are right here in green. And the value of the company, according to the model, is $84 billion. We divide that by 175 million shares, and we get an intrinsic stock price of $480. It's trading at $192, so it's trading at a 60% discount. So it's a buy, according to the model. Let's see what Simply Wall Street values the company at. They're at $320, so they're also saying the company is undervalued. Let's see where the stock has been trading the past few years. So it looks like it peaked around 260, 270 4 or 5 years ago. And it even was about 260 a few months back, but it's been driven down the price. So let's look at the financial ratios to get more information. They have a PE ratio of 22.1, which isn't so great. That's price of stock, which is $192, over earnings per share. And earnings per share is net income, that's 1.5 billion, over 175 million shares outstanding. 8.7 is their earnings per share. They have a price to sales ratio of 11.8, which is also pretty high. That's price of stock over sales per share. And to get sales per share, it's revenue, 2.8 billion, over shares outstanding, 175 million. 1629 is a sales per share. So that implies investors are willing to pay $12 for $1 of sales. I like to see below 2.5 for this ratio. They have a pretty good price to book, 3.7. That's price of stock over book value per share. Let's look at that ratio. Stock price 192, book value 52. So to get book value, it's the equity, which is on your balance sheet, assets minus liabilities, $9 billion, divided by shares outstanding. I like to see below 3.5 when I invest in a company for this ratio. They have a 1.1 current ratio. That's good. That's current assets, 410 million, over current liabilities. So as long as they can cover the current liabilities, they don't need to take on more debt. And their ROE is 17%, which is decent. I like to see above 20%, but 17% isn't too bad. That's net income, 1.5 billion. Remember, net income is on the income statement. It's how much profits the company generates after paying all its expenses in a given year. And that number is divided by the equity, which is the value of the balance sheet, assets minus liabilities. So in 2019, they provided their equity holders a 17% return. Let's look at their interest coverage ratio. That's 32. So they can easily cover their interest payments. EBIT is how much money the company earned in 2019 before it paid interest and taxes, almost 1.5 billion. They had just 46 million of interest payments. They don't have too much debt, so they're in good shape in this category. And the best way to look at ratios is to compare them to similar companies. I've done videos on Innovative Industrial Properties and Stag. They're both in the same industry as Public Storage. And a lot of analysts look at funds from operations when valuing a REIT as opposed to price to earnings, price to sales, and price to book. So that's up here, the funds from operations. And this calculation is the price of the stock over funds from operations per share. And for this ratio, you want a lower number. So Stag is the best, Public Storage is a little behind, and Innovative is a bit higher than them. And funds from operations is net income plus depreciation and amortization minus sales on real estate. PSA has the best PE ratio of the three companies. They're better than the average in price to sales. They're worse than the average in price to book, worse than the average in current ratio, but they're still above 1, so it's fine. They're the best ROE. They're in the middle in terms of debt, and they're bigger than both companies pretty easily. So Public Storage looks like it's a great company with a great future. It has a solid business model. So let me know what you think in the comments. Thanks for watching.